G'day everyone, thanks for tuning in. Ben Kingsley here. Just following on from Bryce and my last podcast, I promised to put together a little bit of data for you to consume in regards to the Sydney market and what happens during boom and bust periods. So look, I just want to unpack this. There's nothing particularly sexy about this, it's just fundamental data. First thing I want to look at most importantly is this chart here. So this is provided through CoreLogic, so RP data, and this is what they call their chart pack. So there's lots of good data information around different cities and what's happening in different marketplaces. Now, what I wanted to just explain to people around the marketplace is you can see here in Sydney, it was having a fairly good time of it. So the black line represents the rolling average change in median prices across the Sydney market, and then the shaded area here is the combined capital cities. So obviously Sydney was doing better than the majority of the cities. It's obviously had a run through here. It's given back a fair bit of the gain, a little bit of gain through here, which is what I want to talk about today. It's had an underperforming period through here, and then it's performed to market average, and now it's also outperforming the rest of the other marketplaces. Now, what I'm focusing in on in this particular conversation is to just articulate some understanding of what happens within a market. So there's markets within markets, but we can see here as the broader Sydney market, the broader Sydney metro, it had a very strong rise through that sort of early 2001 period. And as I said, I bought in this period as well. And obviously, you know, we saw exceptional growth in that property, but we're now starting to get potentially, here's the top of the cycle, and then obviously we started to see a retraction. Now that's still gains, so the property prices are still growing, and then they're still growing through here, but they're not growing as much, and then we see a bit of that give. So what we did is we analysed the market, and let me just go into the data, and you can see here a couple of things. So what I'm showing you here is this. This is the top 10 suburbs that had price gains. So the first one we're going to look at is percentage gain. So from February 2001 to February 2004, which is that upward cycle, we saw cash gains and we saw growth. And so the average growth was 44.5, but 203% growth for Macquarie Links during that time. So the classic case of these particular things is what's happened during this period is land has been sold, so just land value, and then they've basically had construction. So at the completion of the construction, the house and land packages were worth that much. So it's an artificial figure. It's not actually a true reflection of where the growth has come. So it's important to understand that, whereas when you're looking at areas that had existing property on them, is also, you know, not too many of them make that growth story because they haven't been conversions from land packages where houses have then been built on them. So it's important to understand there. Don't just think that, oh, these have been great performers, because in reality, if you look at the data, the historical time frames where those land was released and then houses were built on top of them, then this is not a true reflection of what the true value of those properties has grown at. It's just that obviously we capture a median value at a moment in time, and that median value can go from originally where land is being sold for the first time in a subdivision in a new suburb to when we're actually building on that. So not true correct figures, and that's why I then went and did some analysis from a cash point of view. And it's really important to understand these are the top 10 suburbs that have grown in cash value. And so let's be honest, I mean, that's a great cash return, but in reality, it's not a true cash return because, again, you know, that's where houses have been built. So, you know, $300,000, $400,000 constructions have occurred during that time. Whereas here, these are mature areas where we're seeing the gain in terms of value. Now, from a return on investment point of view, we obviously, at the end of the day, the percentages is not what we live on, it's the cash return that we live on. So let's unpack this. So up until this period of time, the growth over that time was 59, 59, 99, 115, etc., etc. And so the average growth through that period was highlighted here. Now, the correction period, this is what happened during the correction. So we can see the cash given back, we can also see the percentage given back. Now, some of those areas did actually not give back at all. They continue to have some very slow growth, in fact 1% over that period in terms of yearly and then a total of 3. So very, very soft numbers, and obviously some corrections in some of those markets. And you can see the established market, Sylvania Waters, peaked at 1.520 and then basically finished out down at around 865. So that particular suburb had a really tough time of it during that sort of peak and boom stuff. And so this is obviously houses. So down here you can see some of these blue chip suburbs continued to thrive. Others gave back some. So Kyle Bay, as an example, gave, making sure I've got that right, yeah, so gave back some of that gain. And of course, we're sampling it from a moment in time, so you can't be, it can't be a guarantee that that particular monthly median is necessarily guaranteed. It's just for illustration purposes that I'm demonstrating this. The second occurs here. Okay, so these are the top 10 performing units. So these are the suburbs, and that's the unit growth that we've seen. So it's fair to say that obviously during that period of time, these were originally unit values, and that's the increase. So we've seen 100% returns over that growth stage, that sort of boom period. Average returns very, very healthy. Cash returns, obviously during that period, okay. And then you can see here, when the correction occurred, we basically saw a fair bit of that being given back. That's on a cash return on those suburbs, and a percentage return. We see all negatives through here. Just one area here, Kingswood, where it didn't actually give back any of those gains during that correction phase. And then on a cash return, again, these were the best performing cash return areas, so some good cash numbers. But again, most of those areas giving back, the only one holding on was Tamarama. So, it sort of gives you an illustration. That's the top performing suburbs during that sort of February 1 to February 4, 2004 period. So February 2001 to 2004. Now let's have a look at the ones that didn't shine during that boom period and what happened to them. So during that same boom period, we saw these were the worst performing suburbs in terms of what was happening. So, this is the percentage gain. So even though these properties here, you can see the houses had, very, very strong gains and excellent annual gains. The worst performing during the boom period were these ones here, where they still had double-digit growth over the period, but in terms of the overall gains, they were quite poor. And then you can see here in terms of, what happened to them during the correction phase. Well, they didn't give back as much. In fact, some of these areas actually continue to grow. Now, what does that tell you? What it basically tells you is that usually when an area is performed exceptionally well close by, there's what we call a wave effect, and that wave rider effect occurs. And so you can see, even though some of the broader market, and coming back into the picture here, this is this time frame here where a fair bit of that gain is being given back across the broader market of Sydney. What we're actually seeing here is the worst performing suburbs. If we go back into the data, the worst performing suburbs actually had a bit of a kick along, and that's a combination of affordability. It's a combination of being pushed out of that suburb into the next suburb in terms of the broader market. So that's the percentage, and then you can see the cash gain and then what was given back. In the unit stake, the same sort of thing we saw before. In the top performing areas, the correction did occur. It overcooked itself, and that's that emotional buyer who's getting into the market and paying a premium. Yet the worst performing areas, we actually still saw some gains. So where we saw here 8 out of 10 give some gains, and 9 out of 10 give back some percentage gains in those suburbs sampled, you can see here that these suburbs, only 4 and what have we got here, 5, actually had some correction. So it's another point about understanding suburbs within suburbs and suburbs within marketplaces. So looking at a broader market like Sydney, there's a lot of sub-markets inside that. So that's where you need to sort of get your science right around looking at that. So that's all I really wanted to talk about in this particular presentation. In terms of going forward into the future, we'll be talking more about borderless investing, so snapshot on that sort of conversation. You can see that's Sydney, here's Melbourne, here's Brisbane, and those types of things where there's different lagging events that occur. So I want to talk more about that as we put more and more of these podcasts together to continue to build out your education. So I wanted to thank you very much for watching. Hopefully you got something out of that to sort of tell you that there are markets within markets, and the most important thing for me when I was talking about Sydney being overpriced, you can see that the emotional suburb areas have actually given back some of those gains during that period. Some have been surprising. The blue chippers have continued on their merry way, but there has been some gains given back. And if I was to highlight the biggest observation here, I suppose, is if you look at all of that as units, this is my biggest worry about the Sydney market, is that some of these off the plan and newer built apartments are going to give back a lot. So, if you're thinking about buying in a new development, like a lot of our foreign investors are doing, I suspect they're going to lose money in the short term, which has historically occurred, as you can see here, when the market cooled and all those people bought those properties back here and they were built and basically valued back here in the marketplace. They didn't stack up. So, you'd hate to think that you've given back a lot of your gains over that period of time where, your area unit price was valued around 580 and then by the time you actually, took possession of your property, there's $100,000 or $200,000 less in value. That's a horror story for any type of investor. So thanks for watching. If you haven't already subscribed, if you've come across this through a Google search and you don't know about the Property Couch, visit thepropertycouch.com.au and subscribe for our weekly podcast. You can also go and like us on Facebook, Twitter, Instagram, etc. Thanks very much for watching. I hope you took some points out of this, and arrivederci.